Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Well, kia ora and welcome back to another episode of Markets, Mystics and Mayhem. I would say there's a lot of mayhem in markets right now. So we have a lot to talk about what's been going on in the rate space. And we've actually got Weston from Treasury here again. He joined us, I think the last time we had Ross on the show, it was after the October MPR. So Ross, it's been ages since we've had you and there's been a lot of development since October. Why don't you tell us, what's been happening in the rate space from your point of view?
Yeah, it's been highly uncertain, I think. If you did a word count on any sort of economist piece that's been out there, I think the word uncertainty would rank pretty high on word count. And that's been reflected through in what we've seen in trading ranges. Starting with the big brother over in the US, we've seen US Treasuries trade up to year highs and then all the way back down recently down to year lows. And that reflects through into the mighty Kiwi market. But as far as Kiwi goes, Kiwi rates go, they've suffered under the same sort of, range trade sort of volatility. I guess the only constant at the moment is where the path of the OCR is, and that is almost certainly lower from here. We are sitting at 375 now. There is, highly likely to be two more 25-point cuts coming up in April and May, with the option of a third, out into some sort of, time around August, November this year. So that is, sort of making the short end of the yield curve very stable or more stable, but we are sort of getting whiplashed around in the longer part of the curve from 5-year out to 10-year.
So that short part of the curve, that stub that we talk about, pretty stable around 310. Is that right? And if so, what do we do with those short end rates? I mean, from my perspective, there's still a good buy, because if the Reserve Bank cuts to 3, you make a little bit, but if the world gets more difficult and uncertain, then they could easily cut to 2.5% or 2% in a heartbeat. So risk reward, from my perspective, still seems to be long that short end. Do you agree or not?
Yeah, in part. I think the RBNZ have given themselves maximum amount of sort of flexibility in their own range, right? They've given themselves an OCR range of 2.5 to 3.5. And now, if I look at market pricing at the moment, we are pretty much bang in the middle of that range with the OCR, or the market pricing down to basically bang on 3%. So right in the middle. Where do I think things are going to go from here? There's a lot going on, right? We have tariffs, we have, ore leaving, we have data, the high frequency data that has been slowly improving off a very low base. So what markets are doing at the moment is they're saying, yes, we agree that there's going to be near-term cuts, but we are also starting to price in and this is going to seem really odd, but now the market is actually starting to price in hikes, from 1 year out. And that's just on, that rate cuts work and the economy will eventually turn. So there's a real sort of tension going on in the market. It's, near term, yeah, sure, things may get worse. The unemployment rate, may, creep a little bit higher. Growth, on the back of these tariffs may be lower. But what the New Zealand market is thinking at the moment, that eventually interest rate cuts will work, and we will start to see activity out in 1 year's time start to improve. So yeah, we've started to price in a good chance of a 25-point cut from 1 year on. So yeah, really interesting time to be in markets. Yeah, like I say, it's keeping that short part of the curve quite stable, but from there on out, we are starting to get more sort of positive vibes, I guess, going on out and from 1 year out.
I think we would agree with that, right? I mean, that's bang on
our
forecast. So we think the next 6 months is going to be very tough. I'd argue the risk to the cash rates to the downside, but hey, that's just risks, right? If we get through this year and our forecasts are right and we're growing next year, absolutely could be rate hikes. We said that in our last episode, didn't we?
Yeah. I think there are a few sort of domestic green shoots definitely appearing, but it's still really early days, and also it's coming off a very, very low base. So as you say, like, I agree, the risks really are sort of tilted to the downside in terms of where we see things going. I think markets may be a bit more optimistic about the recovery. Not to say that we're not, but I think just globally with everything happening, it is a very uncertain time. And I think we're really worried about that uncertainty feeding through into business investment decisions, which have already been lacking. Business confidence is up, which is great, but it's those investment decisions which still haven't lifted into positive territory, and all the global uncertainty could definitely kind of put a halt to that, and then as such a halt to activity in New Zealand and globally.
Yeah.
And we know that a global slowdown is never good for us here at home either. But Ross, I heard you mention Orr's departure in your little comments before. So what's your take on that, and what did we see markets do off the back of that?
Yeah, I mean, these I read a lot, and a lot of the commentary is that it didn't have much of a reaction, but it's a bit like the high frequency data, that's sort of just showing signs of life. This is just another little what the market would interpret as a little positive step or a little affirmation of pricing in those hikes from 1 year out. We know that Nicola Willis and Orr we're at loggerheads around the increased capital that banks are required to have from 2028. So potentially, if a new governor was selected, you would imagine when Nicola Willis gives her stamp of approval, it would be on the base of agreeing to a slightly lower capital holding. You would assume. So that's the assumption. I think that is starting to be built into markets. That potentially a slightly more or less restrictive capital holding for banks, and that flows through to all else equal. That would flow through to mortgage rates, being slightly lower, i.e., less for the RBNZ to do in the short to medium term. So that's sort of the psyche, I think, that's going on in the markets at the moment. That thinking, forget what's actually published, that's what I think the market is actually, beginning to think, and you'll see that coming through a little bit in the press now. I think that sort of thinking, because it's certainly coming through in market pricing.
Yeah, I think that's a really interesting take, because I think when we've sort of thought about it, or from our point of view, ultimately, Adrian Orr leaving the Reserve Bank, it doesn't change the function of monetary policy. At the end of the day, the Monetary Policy Committee makes decisions as a committee, and they're doing so based on forecasts that RBNZ staff put out. So I would have said the reaction's pretty neutral, but definitely what you're saying in terms of the lower capital holdings, does maybe enable a bit more competition from the smaller banks and lower mortgage rates. So that's a really interesting take.
Well, you mentioned 2028, but banks have been, lifting their capital since was it 2018, Roscoe? It's been a while, right? It's a long process. So any changes to that, you can naturally think that the availability of credit will be a little cheaper than otherwise, a little bit more pro-growth than otherwise. So, yeah, it does actually confirm, some of those green shoots that you mentioned, Roscoe.
Yeah, absolutely. Just staying with the mortgage theme there, I think we talk a lot about about fundamentals and theory and the effect that has on interest rates. But what we forget is you sweep all that to one side and sweep what you think is going on out there. That the Kiwi market becomes very flow based. Now, what we have at the moment, we have a residential mortgage lending is around about, the total size is around about $370 billion. Now, so if you chunk that down and, divide it by 12 and assume that that's all fixed and the rest of it, you have around 31 billion fixing or potentially fixing per month. Now, you don't have to be a rocket scientist to figure out if all of that starts fixing, within a month, that's roughly, just over $1 billion of fixing flow that hits this market per day. Now, that's quite large.
What would the average flow be?
So the average flow, recently, we haven't seen a large amount of fixing. What we've seen is most of it has tended to be shorter. What we see is we get a much bigger effect when that flow starts to shift longer than a year, because balance sheets don't have a natural offset. They don't have term deposits or something, offsetting those. Well, normally we have like 1 year term deposits and a 1 year mortgage, and broadly they start offsetting each other. But when mortgages fix longer, bank balance sheets don't have a natural offset sitting there, so they have to go out into the market and create that asset, or that liability, synthetically, and that's via paying an interest rate swap. And when that market gets out of whack, you get more payers than receivers. That pushes yields higher. All I'm saying is that is a large amount of flow that to hit the market. If that flow starts shifting longer than a year, then that naturally pushes up those rates longer than a year. And what it actually does is it starts filtering down into that into OCR expectations, and you start seeing things like 1 year pricing start to increase just on the back of flow, as opposed to what's really going on out there in the market, i.e. fundamentals. But it is like the 1,000-pound gorilla in the room. It can be a significant flow in this market, and it can start to distort short end yields.
Yeah, I mean, it's happened quite a lot in the past, right? Where you see households, for whatever reason, running to their banks and saying, now's the time to pay. And you get this situation where all banks in the market are faced one way, and you don't have receivers on the other end. I mean, just to put it simply, when you take a 2 year fixed rate mortgage, you're paying us, so we're receiving that, and then we go into the market and we pay. So we effectively offset and lock that in, and that pay side flow can be quite dramatic. It's been quite dramatic. Timing it is the fun part, Roscoe, and this is our jobs. How do we time that flow? I think it's around the bottom of the OCR, but we are starting to see some banks being quite aggressive in the 2 year space now. So it looks like we're getting a little bit now, but I think households will make that decision when they think they've seen the bottom in the cash rate, and that could be more towards the middle of this year. And geez, yeah, I can see a situation where economists like us come out and say that's it, rate cuts are done, we've hit 3%, and then people will go, right, where's my 2 year, where's my 5 year deal?
Yeah, absolutely. It's certainly something to be mindful of when you're when you're looking at this market. It's you've got to dig under the surface to try and figure out exactly what the drivers are, and flow has been one of them.
So are there any areas in the flow and in the book that's kind of keeping you up at night?
What's keeping me up at night is what happens past 2 year. This is the high amount of uncertainty that's out there at the moment. It is driving a huge amount of volatility in this market. it's the on again, off again tariffs, and the effect that's having. We do, I should mention, we do have another US government shutdown at the end of the week. I think it's on Saturday. There's certainly the potential for that to disrupt markets as well. It's uncertain, volatile, but thankfully at the moment it's mostly within a 20-point odd range at the moment. So we're just we're doing this pretty much constantly with a wider range out past 2 years.
Mm. What's your feeling on yields globally, and where do you see them heading towards the end of this year? If you want to talk 10-year. US, Kiwi, and the like.
Yeah, well, I think you've got to imagine that the volatility starts to die down. Like I said at the start, the US Treasuries have hit year lows already. The US still has, much like our own market, still has rate cuts priced in. Until the end of the year. The Fed appear to be in no rush to cut rates at the moment, even though there's still 70 points of cuts priced into the curve. They obviously want to see, the way that tariffs work their way through, whether they're temporary, the sort of Trump art of the deal. Let's push this and see what we can extract out of the rest of the world before we, relent those tariffs. Where do I see them at the end of the year? Under a Trump government, I'd be unwilling to put a number on it, to be honest, because you just never know what's going to come out. It is just so uncertain and so reliant on what he does and says.
I think that's probably the best way to think about it, to be honest. There's upside risks, there's downside risks. The only thing that seems to be a constant is the uncertainty around that. So it is hard to say where those longer end yields are by the end of the year. I could give you a very good argument as to why they're higher, and a very good argument as to why they're lower. It's just we've got to work out what's going to be delivered.
Yeah, especially because right now there's this big fight of, is it an inflationary shock or is it a global weakness sort of shock? And I feel like the two are just fighting it out right now, and it's really hard to know what's going to come first, or whether it's you get one and then the other, and what I guess how long it takes to feed through. If it is inflationary, how long does it take before you do see it turn into more of a weakness story, or do we just skip the inflationary part and it just spreads into global weakness, So it's definitely a volatile time and uncertain. It's hard to give a firm answer.
Which is exciting in itself.
Yeah, I think what we do know, right, is it's going to be under the current structure. It's going to be a low growth global environment, with inflation slightly higher. What I think we're starting to see is like these second derivative effects start to come in. We saw Germany, is a great example. Last week they announced increased spending on infrastructure and defence. Now we haven't seen that in years, and what we saw in the bond market was a significant sell-off in yields. 30 point or 0.3% increase in bond yields in one day. Which is massive for their market. So you're starting to see these these sort of effects go on around the world as everybody becomes a bit more sort of insular and self-protecting in order to protect their own economies, and that is flowing through into yields. So that's why I say it's very hard to say where do I think they're going to be, yields are going to be at the end of the year, because we're dealing with such a random number generator, with some of the political uncertainty out there and all sorts of geopolitical risks going on as well. It's certainly a push and pull market, from a rates perspective.
What a great way to end it. It's a random number generator and all the bang on.
Yeah, absolutely. I don't think I could sum it up any better. But I think, it's really cool that we got to sit down and talk about what all this uncertainty and volatility is doing in the rate space. But this week we also have a bonus episode coming out later in the week where we look at the same volatility and the same uncertainty, and we sit down from Mike Taylor from Pi Funds to really see how that's affecting the equity space too. So make sure to look out for that one. And I think that's all for this week. So if you liked what you saw and heard, be sure to follow us along, like and subscribe, and we'll see you next week. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insight.